There is a strategy in which investing in select Dividend Kings would have crushed the return of the S&P 500 during the last decade. I will reveal this strategy to you in a moment, but first let me explain how I stumbled upon it. In my last episode, I covered all 54 current Dividend Kings, and I ranked them using my custom quality score. This quality score was based on 1, 3, 5, and 10-year growth rates and averages for 6 key financial metrics. If you'd like to know more about the quality score and find out which Dividend Kings ranked the best, there's a link to the episode in the description below. After completing that analysis of all the Dividend Kings, I had a thought that perhaps using a quality score that extends all the way out to the last decade may not be the best metric to design a strategy around. After all, a company may have 9 excellent years, only to stumble in the most recent year. This, of course, may not be materially reflected in a long-term quality score. So I took my custom quality score and truncated it to be based on just the prior year to see what would happen, and the results were quite interesting. To quickly recap here, the quality score is based on the following 6 financial metrics: revenue growth, free cash flow growth, the gross profit margin, the return on invested capital, the dividend growth rate, and the payout ratio. A perfect score is 100%, and in my opinion, a score of 90% or higher is very good. Applying this quality score to all 54 Dividend Kings between 2015 and 2023 yielded an average quality score of 61.14%. This meant that on average, all of the Dividend Kings were rather mediocre based on my quality score. In the Dividend Kings' defense though, my quality score is quite demanding, and the Dividend Kings are mainly mature companies that are past their prime growth years. Nevertheless, let's take a look at how turning the quality score into an investment strategy would have worked out. The premise was simple. Take the quality score from the preceding year and use it to identify Dividend Kings to own in the current year. Then simply repeat this process each year. The average compound annual growth rate for all 54 Dividend Kings between 2016 and December 23, 2024 was 11.2%. In my opinion, that is a pretty strong rate of return for a bunch of mature dividend growth stocks. Of course, when we look at the compound annual growth rate for the S&P 500 for the same time period, it was 14.57%, as measured by the return of the SPDR S&P 500 Trust ETF, ticker symbol SPY. A 3.37% higher CAGR may not seem like a big difference, but over the course of this nearly 9-year test window, it would actually amount to a sizable difference. The cumulative return for all the Dividend Kings was 160.07%, while the cumulative return for SPY was 240.17%. But let's apply different quality score thresholds to all of the Dividend Kings to see at which level they would become more lucrative than investing in SPY. I'm going to start at the bottom and work my way up. Dividend Kings with a quality score below 50% would generate a cumulative return of 87.96%, or a CAGR of 7.26%. Dividend Kings with a quality score between 50 and 60% would generate a cumulative return of 103.79%, or a CAGR of 8.23%. Dividend Kings with a quality score between 60 and 70% would generate a cumulative return of 113.56%, or a CAGR of 8.8%. Dividend Kings with a quality score between 70 and 80% would generate a cumulative return of 238.14%, or a CAGR of 14.5%. So the 70% threshold was the first key metric that would have led to superior results relative to all the Dividend Kings, and actually generate returns almost in line with the S&P 500. Dividend Kings with a quality score between 80 and 90% would generate a cumulative return of 346.56%, or a CAGR of 18.09%. Now we can see that somewhere between a 70 and 80% quality score is that magic threshold that would have propelled this strategy ahead of SPY. And if we push on to the highest decile of quality scores, above 90%, we have a cumulative return of 442.43%, or a CAGR of 20.67%. We can see a clear pattern that higher quality scores led to higher rates of return. But let's dig a little deeper to find the actual thresholds that led to the best overall returns, and see how many Dividend Kings we would have invested in each year. I'll start by testing the average quality score for all the Dividend Kings of 61.14%. With this threshold in the top row here, you can see the cumulative return is 176.25%, with a CAGR of 11.95%. The second row shows the average return for all of the non-chosen Dividend Kings, and that cumulative return is 140.42%, with a CAGR of 10.24%. Just below that, in the third row, we have the average return for all of the Dividend Kings, and the return for SPY in the fourth and bottom row. Using a quality score threshold of 61.14%, we would have invested in 26.1 Dividend Kings on average per year, and this would have improved our return over investing in all the Dividend Kings by roughly 16%, or 75 basis points per year. But we would have come up short of SPY by nearly 64%, or 262 basis points per year. We would need to kick the quality score threshold all the way up to 79% to beat SPY. At this threshold, the cumulative return improves to 267.41%, with a CAGR of 15.56%, and this puts us 27% ahead of SPY, or by 98 basis points per year. Also, at this threshold, we would hold roughly 8.8 Dividend Kings on average per year. To push the cumulative return above 300%, we would need to tighten the quality score threshold to 83%. This would trim the average number of Dividend Kings in the portfolio down to just 6 per year on average. But now, we would generate a return about 64% better than SPY, or about 224 basis points better per year. By tightening the quality score to 89%, we would push the cumulative return above 400% and see a CAGR of more than 20%, 20.44% to be exact, with a cumulative return of 433.17%. This, of course, trims the number of chosen Dividend Kings down to just 3.2 per year on average, so the strategy is becoming very concentrated. But it does beat SPY by 193%, or about 587 basis points of alpha per year. What's interesting to note here is that this strategy beats SPY between 2016 and 2022, but it underperforms last year and in 2024 by quite a bit actually. 9.01% of underperformance last year and 7.95% this year. The best outcome is derived with a quality score threshold of 92%, generating a cumulative return of 541.77%, or a CAGR of 22.94%. The number of chosen Dividend Kings per year is just 1.9, so a really concentrated strategy. This strategy beats SPY in 8 out of the 9 tested years, with 2016 being the only losing year. In total, we have an outperformance of 301.6%, with 8.37% of annual alpha. Let's break down this portfolio and see which Dividend Kings were chosen each year and the type of return they generated. In 2016, only one Dividend King was selected, and that king was AbbVie. AbbVie returned 9.79% in 2016, underperforming SPY's return of 12% that year. In 2017, 3 Dividend Kings were chosen: Lowe's, Nordson, and S&P Global. Lowe's returned 33.29%, Nordson returned 31.83%, and S&P Global returned 59.31%. That's an average return of 41.48%, with an equal weight to these 3 Dividend Kings. Meanwhile, SPY returned 21.71% in 2017, meaning that our strategy generated 19.77% of alpha that year. In 2018, only one Dividend King was chosen, S&P Global, and it returned just 1.37%. However, 2018 was a sour year for SPY, as it finished the year down 4.57%, which means our strategy generated 5.94% of alpha. In 2019, 2 Dividend Kings were chosen, ADP and Illinois Toolworks. ADP returned 32.7%, and Illinois Toolworks returned 45.61%. This gives us an average return of 39.16%, compared to 31.22% for SPY. That's 7.94% of alpha. In 2020, just one Dividend King was chosen, and it was S&P Global again. The stock returned 21.4%, compared to 18.33% for SPY, so another 3.07% of alpha generated for our strategy. In 2021, 3 Dividend Kings were chosen: Lowe's, S&P Global, and ADP. Lowe's returned 63.34%, S&P Global returned 44.68%, and ADP returned 42.6%. This equates to an average return of 50.21% versus just 28.73% for SPY. That's 21.48% of alpha and the best winning margin in this test window. In 2022, two Dividend Kings were chosen, Nordson and Abbott Labs. Nordson posted a loss of 5.93%, and Abbott Labs posted a loss of 20.68%. The portfolio finished with a loss of 13.31%, but SPY fell by 18.18% that year, giving our strategy 4.88% of alpha. In 2023, two Dividend Kings were chosen, Grainger and Nucor. Grainger returned 50.54%, and Nucor returned 33.76%. The portfolio return was 42.15% versus 26.18% for SPY. That's 15.97% of alpha. And in 2024, two Dividend Kings were chosen, ADP and Grainger. ADP has a return of 29.03% through December 23rd, while Grainger has a return of 31.65%. The average portfolio return this year is 30.34% versus 26.72% for SPY. Another 3.62% of alpha with just a few more trading days left in the year. To give you a little perspective, a $10,000 investment into this strategy without any tax drag would be worth $64,222.92 today. The same investment into SPY would be worth only $34,017.24 today. So our strategy would grow to nearly twice the value of an equivalent investment into SPY. Using this same strategy, based on the most recent financial data, the highest ranked Dividend Kings as of today are ADP with a quality score of 97.15%, Cincinnati Financial with a quality score of 92.81%, and Grainger with a quality score of 91.01%. Given that we're almost at the end of the year, these three would be the selected Dividend Kings for 2025, or just the first two if we stuck to the 92% quality score threshold from the optimal strategy I just covered. It'll be interesting to see what type of return these Kings can deliver in 2025, and how that return compares to the return for SPY. There is one caveat to this strategy I have yet to cover, and it's quite a big disappointment. While the total return from this strategy was phenomenal, its dividend track record was rather unimpressive. You would expect a dividend-focused strategy to offer a growing passive income stream of dividends. However, with the annual turnover the strategy required, the effective dividend yield for this portfolio was all over the place. And suffice it to say, the dividend track record was not consistent. Using a $10,000 investment as the original starting point, and assuming no tax drag on the portfolio, here's the annual dividend income this strategy would generate. $563.66 in 2016, $189.86 in 2017, so quite a large drop. $195.28 in 2018, so only a marginal improvement. $518.87 in 2019, a pretty wild upswing. $224.55 in 2020, another significant decline relative to the prior year. $461.72 in 2021, $469.61 in 2022, $510.11 in 2023, and $860.35 this year. So as you can see, the dividend income was all over the place, as the strategy rotated in and out of higher and lower yielding stocks from year to year. Like I mentioned before, the total return was phenomenal, but the oscillating dividend income from year to year really does not make this an appealing dividend strategy. To fix the dividend income problem, the strategy could be converted into a buy and hold strategy, but this would however hamper the total return. I tested a hypothetical portfolio to see how a buy and hold strategy using these stock selections would work out, and it finished with a cumulative return of 248.69%. Which is a significant decline from the 541.77% total return in the original portfolio that rotated in and out of the chosen stocks. The buy and hold portfolio assumed a $10,000 investment into the portfolio at the start of each year, and that money was split equally amongst all of the chosen Dividend Kings for that year. To make matters worse, even though the buy and hold version of the strategy generated a better cumulative return than SPY, the actual portfolio had a lower market value at the end of the test period. The reason for this is the annual cash flows. Since the portfolio became larger over time as a result of more money being invested, this meant that more recent returns played a more significant role on the final market value of the portfolio. To normalize the return comparison, we would need to look at the money-weighted rate of return for this portfolio, which was 13.32%, and the money-weighted rate of return for SPY, which was 15.15%. So in the end, if total return is what you care about most, this strategy might be useful to check out. And if consistent and growing dividend income is your primary objective, this is likely not a strategy for you. That's it for today. I plan on expanding this type of quality score analysis to a broader universe of dividend growth stocks to see if I find similar patterns. That research will be shared on my Patreon and in my free newsletter, Quality at a Fair Price. So if that sounds interesting to you, make sure to subscribe so you don't miss future updates. Thanks for joining me, and don't forget to give this video a like. See you next time.